If you don't understand market structure, this won't make any sense to you, and you could just watch my last video. But I made this little diagram right here of my understanding of ICC. This is a bullish example. So prices going up, it came into a level of sellers, they knocked it back down, then we came up again and broke out of those level of sellers. That's the indication, the blue line. Then as we're coming back down, that's the correction, the purple line. You don't trade the indication or the correction, you'll trade the continuation. You enter once price comes back above the level where it originally broke out of the sellers or broke structure. Right there, your stop loss will be the low that it made, because that's going to be the new higher low. And then your take profit, you can take profit at the top, or you can hold it for longer, but you're only going to take an entry right here if it makes sense to do so. So that points me to my rules. The most important, to avoid fake outs, only take the entry if structure has shifted back in your direction on a 5 to 15 minute time frame. So what I mean by that is right here. So you see, this was the indication, price starts correcting, this represents a 5 minute time frame. So as you can see, price dipped into here and it came back out. So based off of the other model, you would get in right here, stop loss here, target there. But the problem with this is we have not shifted back to the upside. So likely it's going to come right here, bounce off of like some 5 or 15 minute supply and keep going down because it's not ready to reverse yet. So if it looks like this, you would not enter yet. As you can see right here though, we're correcting, then price takes us out, a change of character, market structure shift, whatever you want to call it. It happened before we came back above this line. So now whenever we do get above this line, we're okay to enter, and you can put your stop loss at this low or the overall higher low. So what if we coming up here and it doesn't go back down and it just keeps going up? In that case, when it does come up above, you could just enter right there, stop loss here, or you can wait until it does a retracement and then comes back above that line, just like ICC on a 5 minute time frame, and then you could still make that your stop loss or that your stop loss and target up here or higher. Okay, this is an example of a fake out. So we're correcting up into here, right? But if you look, we're coming down. So most people would enter right here, the stop loss will be here, and then they'll be targeting down there. But if we play it forward, you see, we get down here, a lot of people would be in right now. But the thing about that is, this is a demand zone right here. So yes, we came under the line, but we're still in demand and we've broken no structure to the downside. So this is likely going to bounce off of here and keep going up. Or for me to get in, it would need to completely break this zone. Then I would get in and put the stop loss right there. But let's play it forward. See, so you would have got stopped right out because it just went in demand to keep going up. It's still building upside structure. So the whole key is you want it to break structure to the downside before we come under this line. Otherwise, it could end up being a fake out just like this. Okay, so now if it comes under this line, it's okay to buy as soon as it comes under because we have had a change of character to the downside already before coming under. So now that it's okay to enter, this would be your trade setup. Boom. So this is an example of when it's okay to enter. We have our indication we broke out of this level of buyers. Then once you see price starting to correct, you switch to a 5 minute time frame. The 5 minute looks like this. We're uptrending. As of right now, it would have to come below this point to be a change of character or a market structure shift back to the downside. Like if it comes down to this entry, we know we done passed a lot of upside structure. So it would be okay to enter because price is going to change to the downside before we get down here. So when price actually does get down here, you enter as soon as it breaks this line. Your stop loss is here, and you could target here or you could hold it for longer because you're trying to catch the trend. That's what SI does. And then if we play it forward, well, that, like, I don't know what happened there. That was a major dump, but as you can see, you would still, and then you would have had no reason to get out yet. So you would still be holding this until structure changes to the upside. I think that's how he does it. Okay, so here's another example. We're on a 1 hour time frame. That's the indication, and we're starting to correct. So okay, so we're coming down into the line. Boom. We came in here, we tapped into it, and we start coming up. A lot of people would have gotten in this because we came back above the line, but it does not make sense to do that because we have broken no structure to the upside. As of right now, we would have to go above this point to break structure to the upside. So I would still be waiting. And as you can see, you would have got stopped out. So since we did a break of structure to the downside, right now I'll be waiting on it to pass this point. So even if we come back up here again, I'm still not getting in yet because we still have not broken structure to the upside. So at this point, you could just enter right here as soon as it passed, stop loss there, or you could just simply do ICC on the lower time frame, let it go up, come back down, and then once it crosses above, you get in. So at this point, your trade will look like this.